Hey everyone, it's Lewis here with Crypto Elite, and in today's video, we are going to be going over the most important thing that you can even know about if you are going to be trading for the long term. Anyone can get lucky when there is a bull market and they just throw money in and they say that they're a trader and the things go up and they make a bunch of money. Everyone knows that. But what happens when the markets aren't as stable? What happens when the markets do something like what they did in 2018 and crash? What happens when you don't have any risk management and you end up losing a lot of your portfolio? Well, if you know risk management, then you will prevent that from happening and you will be able to trade for the long term and continually grow your account day after day or week after week or month after month or however long you trade for. And that is why today we are going to be going over risk management, which is the most important topic. There's a lot of things that we're going to cover here, so let's go into it. First thing though is the disclaimer. As a disclaimer, Lewis Raskin / Crypto Elite is not a financial advisor. Nothing in this presentation or any form of communication, whether that be Twitter, Instagram, Telegram, Facebook, email, or anything else by me, Lewis Raskin, or Crypto Elite is financial, trading, investment, legal, or professional, or even personal advice. Trading and investing is risky, so you have to do that at your own risk. Profits are not guaranteed. You are solely responsible for what you do with your money, and you should never trade or invest with more money than you cannot afford to lose. Now, with that out of the way, let's go on to the outline of this presentation on risk management. The first thing that we're going to do is go over some big picture things. Then we're going to go over into the typical scenario of a trader. And then we're going to actually get into why you should manage your risk and then go into the details of the different parts of risk management. These are all laid out here. I won't go over them, but you could pause the video and look at all of them if you want. Then finally, we'll go into some advanced concepts that pertain to risk management, such as market cycles and market psychology. And we will also do some examples, which I have noticed in a lot of training videos are left out. So examples. I learn by examples. Hopefully you do too. So you can see exactly how I personally manage my risk on my trades. Some things that we won't cover are the really, really advanced concepts like hedging and leverage. So we'll have more advanced concepts such as hedging and leverage like down the road, but right now this is sort of a lot of information that you're going to be getting in here. So let's keep it as simple as possible so that you can understand how to manage your risk. So going into the typical scenario of how you should manage your risk, let's just first go over the 4-step process to trading without risk management. Because we all know that if you trade with risk management, you'll be protecting your capital. But what happens if you trade without it? Well, this is the 4-step process. You might start winning a ton of trades. Then you think you're God. You'll not use any risk management. And then you'll wipe out. And you'll blow your account. That is usually how the typical scenario goes for most traders. In fact, 90% of traders tend to lose 90% of their portfolio within 90 days of trading, whether they start out winning really, really well. And you can see this guy right here winning super elated. Maybe that was you. And then the market crashes and they don't have any stops in place, any management for their risk, and they just cry. Now, you don't want to cry. You don't want to be this guy. You want to be this guy. So, well, actually, you actually don't even want to be this guy. You want to, be level-headed and not really show too much emotions in your trading journey. But preferably, you would rather be him than him. So, what does this mean? This is like the typical scenario. Basically, you start to trade crypto. Your first trade is a winner. Your second trade is a winner. Your third trade is a winner. And just imagine this right here. Just imagine that this was you. You started winning all of these trades. You're feeling like a god at this point. You're unstoppable. You add more to your next trade and you win that one too. You're 4 for 4 at this point. You're on top of the world. The next trade, you go all in because, well, you've been crushing it, so why not? You end up doubling your account on that 5th trade. This is incredible, you think to yourself. You started out with $5,000 and you're already at about $12,000. Trade 6 comes around, you see the perfect setup, you throw your entire portfolio into this one as well. And I mean, why not? Your last one doubled your account. The trade starts to go against you though. You think to yourself, this is just a little correction, I just got in a bit too early, it'll bounce. Then the price bounces and you give yourself a pat on the back. You walk away and you wait for the price to hit your take profit. You come back to the chart the next day, and it turns out that that bounce was short-lived. After you walked away, it ended up coming back down below your entry again. You say, I'll just hold on to this one. It has great fundamentals. You hold. The price keeps moving down. The price is 8% below your entry at this point. You want to get out, but there's support just a few percent below where the price is right now. It'll bounce there. You hold. Price hits support and stays there for a little while. You wait for the bounce. Before you know it, the price dumps through the support, and you wait for any type of bounce, but it never comes. The price keeps falling. You blink, and you're down 40% on your entire account. You can't take it anymore. You're so angry at yourself. It's okay, though, because you're still up overall. You decide to just exit the trade. You take a 40% loss to your account, and you exit the trade. Seemingly out of nowhere, as if the market was just waiting for you to sell, the price jumps up 10% immediately. You FOMO back in. Before you could blink, the price nosedives back down 10%. It was a manipulative spike. They got you. Now you're down 50% on your entire account, and you're disgusted with yourself. You had $12,000 before you started this trade. Now you're down to $6,000. How could you have prevented this catastrophic loss to your account? 2 words: risk management. Today, we're going to be taking a deep dive into proper risk management, and you are going to learn everything you need to know so that you could protect your capital and consistently increase your account over time without ever wiping it out. So, why manage risk? You want to manage your risk because in trading, there is a 100% chance that you will lose significant portions of your account if you never use risk management. Risk management is the most important aspect of trading, so be sure to take notes and practice these concepts over and over again until you have them down. Remember, not losing money is more important than making money in trading. Don't think of yourself as a trader, but rather think of yourself as a risk manager. Protect your capital for as long as possible so that you could go hard as possible when the time comes, which happens once every few years in the cryptocurrency space. Know how to trade both crypto and stocks, and you'll be able to move your money around and take even bigger advantages of the opportunities when they come. For example, in 2018, if you took your money out of the cryptocurrency space and you put them into the stock market, especially weed stocks, you would have done extremely well. So knowing the different markets is another tool that you could use to exponentially grow your accounts. Finally, if you understand the big picture of the markets, you'll understand why you should think of yourself as a risk manager rather than a trader. Now, let's just go over this. Risk management, like I mentioned, is the most important aspect of trading. So, why should you think of yourself as a risk manager instead of a trader when it comes to trading? Well, like I mentioned, if you understand the big picture, that's when it makes sense. Opportunities come around every so often in trading. What happens with markets is that they are usually boring, and you usually either make very little money or you lose money for most of the year. And then maybe 1 or 2 times within a year, there will be spurts of extravagant growth that you could take advantage of, which will easily make up for all of the losses and a lot more. Most of the money you make will be made in a very short period of time every year or so. In 2018, there was 1 month from April 6th to May 6th where you could have made extravagant gains. For the other 330 days of 2018, the market was in a downtrend and the opportunities to make significant gains were not available. Trading is not a get-rich-quick scheme. If you've seen my videos on market cycles, this does make perfect sense. You trade conservatively for as long as possible, and then when the opportunity for massive gains presents itself, that is when you increase your risk and you go for the home runs. Those opportunities don't happen very often. It's important to understand that you will lose trades and you will have losing weeks when it comes to trading. So protecting your capital during these times is paramount if you want to stay in the game for the long run. If you can protect your capital by managing your risk and wait for the high probability setups, that is how you will consistently grow your account year after year. Let the market come to you and calculate your position size for every single trade. That is the only way you will be profitable in the long term. You can win trade after trade after trade without using any risk management, but if you continue to not manage your risk, you will eventually wipe out your account. This is a statistical guarantee. So something that you should know is that risk management, it falls on a spectrum. So you could be a riskier trader or you could be a more conservative trader. Whatever your trading style is, the rules do remain the same though. The thing about risk management is that it's different for everyone. Some people accept more risk while others like to trade more conservatively. So wherever you may fall on the scale of risk management, the rules remain the same. You have your entries, you have your take profits, and you have your stops. So what are the different parts of risk management? We just covered a couple, but like the different parts that you must know about when it comes to risk management include your stop loss, and that's the price that you will cut your trade if it starts going against you. You'll have your take profit target, and that's obviously where you will take your profits. You'll have your risk per trade, and that is how much of your account you're willing to risk on the trade, which is usually 1 to 3%. So if you have a $10,000 account and you're risking, 3% on that particular trade, then you're risking $300. And we're going to get into this very in depth in just a second. The other different parts of risk management include your position size, which is how much you're betting on the trade, your reward to risk ratio, which is how much you will win if you win, compared to how much you will lose if you lose. Obviously, you want to win more if you are going to win compared to if you are going to lose. Normally, you want to have a higher reward to risk ratio so that if you win a lot more than if you lose. You should also know your overall win rate percentage and your win rate percentage for each particular trading style that you use. This is basically how you determine what your edge is. If you find a trading style that works really, really, really well, then you have a really good edge. And also it helps you to stop doing the trades that suck. Like if a particular strategy you use just keeps on losing, then obviously stop it. If it wins a lot, then do it a lot more. And then finally, the other part of risk management is the quality of your trade setups, which is the probability of it working, which is basically your win rate percentage is you could figure out the quality of your trade setups. Some advanced topics of risk management include understanding the market cycles and where we are. And if you do understand this, then you will be able to adjust your targets based off of the market sentiment and where we are in the market cycles. The better the markets, the more bullish the markets, the higher your targets can be. The crappier the markets, the more bearish the markets. You either want to stay out or you want to set low targets and rack up those small wins over and over and over again and being very conservative until we get those better big bull market moves. And then you could, increase your take profit levels. Another advanced concept of risk management is hedging and using leveraged exchanges. That is very advanced. We're not going to cover it in this lecture because it is not necessary for 99% of traders. The thing about trading is that trading and risk management can be deceiving. You could do things wrong and you can win. You can do things right and you can lose. Do things wrong for long enough though, and you will always end up losing. The goal of a trader is to make a good trade. It's not to profit. Profits come as a result of consistently putting on good trades. The most important thing to do is to plan your trade and to trade your plan. 3commas.io, that is a software that is a must for all crypto traders in my opinion. I'll have a link for it in the description, and what 3commas does is it allows you to plan your trade and then put all of the information in and then actually execute your trade according to your plan. You can't do this on cryptocurrency exchanges right now. It's really pathetic and it's sort of stupid, to be honest. So I don't recommend trading without 3commas because 3commas literally lets you practice proper risk management. And going over this, it's basically like the first thing that you need to know with trading is that with a lot of things, you can recklessly gamble your entire portfolio on a single trade and triple your account on that trade, right? But over time, if you continue to do that, you'll end up wiping out your account and losing your money. It's much better to follow a set of good trading principles each and every trade than to gamble, even if you get lucky, because you don't want bad habits to be ingrained in you. And like I mentioned, the goal of a good trader is to make a good trade. It's not to profit. Profits come as a result of consistently putting on good trades. It's also important to know that you could still lose money even when you make good trades. Sometimes the markets just aren't in your favor. Consistency is what is key. Also, like we talked about in the series on how to trade and invest into Bitcoin and cryptocurrencies, if you could find a really good edge, you can limit the amount of times your trades actually lose money. The most important thing to do is to plan your trade and trade your plan. I'm reiterating this again because it's so important. If you have a set of rules that you follow and you go through each of them every time that you trade, you can plan everything out beforehand while you're nice and calm and relaxed. Okay, then you could put all of that information into your trade, into the trading software, 3 commas, and then you can just let it play out. If you don't have 3 commas or you aren't aware of it, it's a software that you could connect your exchange to so that you can put your entry, your stop loss, your take profit, and everything else all at once. Like I mentioned, crypto exchanges don't allow you to do this right now. That's why we have to have a third-party software. And honestly, that is why so many people end up losing money. It's because they don't have the time, or they're not in front of their computer 24/7 and they can't do it. But with 3 commas, you could set your trade and you could walk away and everything will be executed as soon as it happens. And you won't have to constantly check on the trade or be forced to choose between setting a stop loss or a take profit, which makes you more emotional and more likely to change something or deviate from your plan and screw up your trade. So if you do not have 3 commas yet, there is a link for where you can download it in the description. Remember, the best traders are unemotional. You want to base your trades off of TA, technical analysis, or FA, fundamental analysis, preferably both, because if you get both TA and FA lining up, then that makes for the best trades. You want to plan your trade, you want to trade your plan, and you don't want to overtrade. You want to have everything set up beforehand and be executed automatically for you. You want to remove your emotion, and you want to try to automate things as much as possible. So at the beginning of this lecture, we went over the different parts of risk management. So just to reiterate them, they are your stop loss, your risk per trade, your position size, your reward to risk ratio, and your overall win rate percentage and your win rate percentage for a particular trading style. Those are the basics that you need to know when you're dealing with risk management. And then we have some advanced concepts of risk management, and these are understanding the sentiment of the market. And that involves setting higher targets when the market is more favorable, setting lower targets when the market is less favorable, and lowering your overall risk when the market is less favorable. Basically, when we're in a bull market, you can be a lot more riskier. The second one is having the patience to wait for optimal setups. A lot of people just want to jump in all at once and, just trade. But if you take a step back and you wait for the optimal setups, you'll increase your win rate percentage by a lot. Then some other advanced concepts are hedging your bets, which means that you're long and you're short at the same time, and then you cut one of the trades once you get a confirmation on the other, or you simply, there's a lot of different ways to hedge your bets, but that's the main one. And then there's staying out of the market altogether or going into another market. I touched on this a little bit before, how the weed stocks in 2018 went up like crazy while the crypto market sort of crashed. So if you know other markets, that's another form of risk management where you could just literally get out of one market entirely and then go into a different market. You could cut a percentage of your position instead of all of it at a particular stop loss. So this is a stop loss strategy, and we're going to be going into a lot of different stop loss strategies in this video. Instead of cutting all of it at once, you just, cut like 25% of it or 50% of it, or you stack your stops. And then there's adding more to a position if the price moves down. And if you have some fundamental knowledge and it's just a shakeout, and that's super advanced. Most of the time you want to just cut your trade if it hits your stop, but sometimes if the price goes down and you're in a long-term position, long-term swing trade, you actually can add more to it and then lower your average buying price. And, if you learn that, that is like a whole new level. Then there's trailing your stop losses and trailing your take profits, and then having multiple stop losses or multiple take profits. And we're going to be going over a lot of this type of stuff. So overall, how do you manage your risk? Like, those are all the components of risk management. How do you manage it? You manage your risk by basing your trades off of technical analysis, not off of pure emotion. You have to have set levels that make sense on why you want to take your profit at that target, on why you want to have your stop at that level, and on why you want to enter at that level. It should be based off of technical analysis, not just, oh, this looks good, and then you just buy it. You want to take your profits, you want to let your winners ride, and you want to cut your losers quickly. Be slow to enter, but be quick to leave. That is a saying that I think is really, really important to know. When the price hits your stop loss, you need to cut your trade as quickly as possible so that you preserve enough capital to go into another trade. And you should practice risk management no matter if you're trading with $1,000 or if you're trading with $100 million. Okay, so there's different terms that you need to know when it comes to trading, so let's go over them. The first one is your trading portfolio. Your trading portfolio is the total amount of money that you are trading with. You need to know this every single trade. You need to know your trading portfolio. It's how much money is in your trading account. It's not how much money is in your trading account and your investment account. No, it's just your trading account, just the money that you're trading with. How much money is that? That is your trading portfolio. Then you have your risk per trade. This is the percentage of the total amount of your portfolio that you're willing to lose. For example, if your trading portfolio is $10,000 and you don't want to lose more than $300 on any given trade, then your risk per trade is 3%. 3% is the maximum amount any serious trader likes to risk. So that's your risk per trade. Your risk per trade is the percentage of the total amount of your portfolio you're willing to lose. So you only want to lose, if you lose, maybe you'll lose 1%, 2%, or maybe 3% of your entire portfolio. This is not your stop. This is different than your stop. This is how much of your portfolio in percentage terms you're going to lose if the trade goes against you. And it should not be that much, 1 to 3%, maybe a little bit more if you're more risky. Then you have drawdowns and recovery. So how much money you lost from your portfolio and how much it's going to take to recover what you lost. You have your stop loss, which is, the risk percent of the actual trade. It's the percentage from your entry to your stop loss. It's basically where you're going to cut the trade when it goes if it goes against you. That's your stop loss. You have your position size, and that is the total amount that you put into your trade. So if you have a $10,000 portfolio and you put in $5,000 into the trade, that is your position size. Your risk to reward ratio. I actually prefer to call it your reward to risk ratio, but a lot of people like to call it your risk to reward ratio. Either way works. That is the amount you will win if you win compared to the amount that you will lose if you lose. Then you have your overall win rate, which is the percentage of the total trades that are winning trades. So to calculate this, it's super easy. You just take the number of winning trades and you divide it by the total number of trades, and then you multiply it by 100. So for example, if you put on 10 trades and you win 7 out of the 10, your winning percentage, your overall win rate is 70%. That's really, really good. And then you have your trading strategy win rate or your edge. What this is it's the total, it's the percentage that you win given that particular trading style. So if you always say you always buy at support, and that's your trading style or your trading strategy, and you win, 80% of the time that you do that, then that's your trading strategy win rate. If you always buy at the 61.8 and you win, 60% of the time, that's your trading strategy win rate. Trading portfolio. So one by one, let's go over these. Trading portfolio, the total amount of money that you're trading with could be measured in either USD or Bitcoin value. You need to always know your portfolio balance so that you can calculate your position size for every single trade. Your trading strategy win rate or your trading edge. This is super important to know because normally you don't want to risk more than 2 to 3%, maybe even 1 to 3% of your portfolio on any given trade, right? But if you have a particular edge for a certain strategy that you use, you can risk more and you can increase your account much faster. And this is especially important for smaller accounts when you want to really grow it a lot faster. So if you have, a trading strategy or a trading edge that you win like 90% of the time with it or 95% of the time with it, you could risk a lot more than 2 to 3% of your account. Sometimes for some very, very rare occasions, I'll go up to 10%, if my entire portfolio on those type of winning trading strategies that win like 90% of the time, that win like so much, and I'll bet a lot more on it. So that just comes with time and with testing out different strategies. And usually the higher the win percent for the particular strategy, the less often it comes about. So a lot of times those type of trades, they might only come about every few weeks or so. Then you have your risk per trade. So this is the percentage of the total amount of your portfolio that you're willing to lose. For example, if your trading portfolio is $10,000 and you don't want to lose more than $300 on any given trade, then your risk per trade is 3%. 3% is usually the maximum amount any serious trader risks. Most only risk 1 to 2% of their portfolio per trade. Like I said, this changes with your win rate percentage for your particular trading style. But as you grow your account, as your account keeps on continually growing, once it gets into like six figures, you probably want to keep this at 1 to 3%, 1 to 2% if it gets into six figures. If it's still in five figures though, some people like to do it up to 5%. Some people are super aggressive, like me, and on very rare occasions, they'll do it all the way up to 10%. So yeah, that is your risk per trade. So the actual dollar or Bitcoin amount that is risk, it's going to change after every trade because it's based off of your total trading portfolio. So if you only want to risk, say, 1% and you start out with $10,000, then your first trade, you will risk $100. Because $100 is, 1% of $10,000. So if you win $500 on that trade, then on your next trade, if you want to stick to your 1% risk, then you'll risk $150 because $150 is 1% of your new portfolio's balance. If you lost that first trade and you lost the $100, then your portfolio would now be at $9,900. 1% of that is $90. Even if you grow your account to $100,000, you can still only risk 1%, but the number risked will be $1,000 in that case. So because your risk per trade is a percentage, it can remain the same, but the actual dollar amount will change as your portfolio changes. Like I mentioned, if you have a good edge, you could increase your risk per trade. And like this mentions, every single time you put on a trade, you need to know your portfolio balance, and you need to calculate your risk per trade based off of your portfolio balance. Like if you start out with $10,000 and then you go up to, say, like $25,000, you're going to need to calculate your risk per trade based off of the new, $25,000 that you have. And if you lose a bunch of trades, if you start with $10,000, you go down to like $7,000, you need to calculate your risk per trade based off of the new $7,000 that your account has. And we're going to be going over a lot of examples, so don't really, worry about it too much. Just understand that this is the way that you trade. Okay, now we're at the stop loss level, and this is the sell order that exits your trade once it reaches a certain amount of risk. Your stop losses should be at levels where your trade idea becomes invalidated and doesn't make sense anymore. Stop losses protect your capital in case the market moves against you. Whenever you put on a trade, you are putting on that trade because you believe that the market will perform in a certain way. If the market doesn't act the way that you expect it to, your stop loss will be there to get you out of your trade. You can have either a stop limit order or a stop market order. A stop market order will sell your coins at the current market price. Now, when you use stop losses and you put on a market order, you basically always want to use market orders for your stops, even though you might sell a little lower than you want if there aren't enough people willing to buy at that exact price that you set. However, you will always sell when you use a market order. If you use a limit order, that tells the exchange that you want to sell at the price and that price only, the price that you set, the limit price that you set. So if no one wants to buy at that price, then your order won't get filled. And this means that there's a chance that the price could just fly right past your stop if it's set as a limit order, and you won't get out of your trade. And that's why it's suggested to always use a market order when dealing with your stops. The other thing about stops is that if you feel that if your stop loss triggers, it's going to emotionally damage you, then lower the amount of your position size. Then we have drawdowns. So drawdowns, when you don't use a stop loss and the trade runs against you and you end up losing a lot of money, that's a drawdown. The higher percentage of your drawdowns, the higher percentage your gains need to be in order to recover and break even. As losses get bigger and bigger, the amount you need to gain back just to break even becomes bigger and bigger as well, except it becomes exponentially bigger than the amount that you lost. For instance, if you lose 20% on a trade, you need to recover 25% for it to get back to break even. It has to go up 5% more just to break even from a 20% loss. If you lose 40% on a trade, the asset needs to move up 66.7% in order for you to get out at break even. These drawdowns and recoveries get exponentially bigger as you lose more. If you're down 60% on a trade, that asset needs to increase in value by 300% just to get back to break even. This is why making sure you don't have substantial drawdowns is essential in trading. And this right here is a chart that shows how much a coin or an asset needs to go back up in order to get back to break even after a drawdown. Since the percentage you need to gain exponentially increases as the drawdowns get bigger, it should make sense as to why you want to cut your losses early. If you cut a losing trade at 10% down, you can make up that trade with an 11.1% win. If you wait to cut your trade until it occurs a 50% loss, you'll need to win 100% just to get back to break even. So definitely, this chart made it clear to me as to why we should have stops in, and hopefully it does for you too. Okay, so now we're at the position size. This is the amount of money in the USD or BTC, whatever you're trading with, that you'll put on in your trade. It's based off of your portfolio balance, your risk per trade, and your stop loss. Your lot size is the amount of cryptocurrency that you're buying. It's slightly different, but it's good to know. So say that you have, 1,000 Bitcoin and you're trading it for Tron. Your lot size would technically be how much Tron you're buying, while your position size is the amount of Bitcoin that you're putting into the trade. To calculate your position size in USD for each trade, it's super easy. These are the steps. You just look at your portfolio balance in USD. You multiply that by the percentage you're willing to risk for your trade, which is, typically 1 to 5%. And then you divide that number by your stop loss percentage. So the equation goes like this. Position size equals portfolio balance times risk percent divided by stop loss percent. Here is an example to calculate your position size in USD using a $10,000 account. So let's say you have $10,000 as your trading portfolio. Your risk per trade is 2%, meaning that you're not going to lose more than 2% of your trading portfolio on this trade. And your stop loss is 4% away. Well, $10,000 is your portfolio balance. You multiply that by 0.02, which is your risk percent. And then you divide that number by 0.04, which is your stop, and that gives you a position size of $5,000. If you're only concerned with USD, then that should be all the information that you need. If you need to find out how much Bitcoin that you're going to buy, you would just divide your position size by your entry price. If your entry price was, say, $10,005 per Bitcoin, then the amount of Bitcoin that you would be buying would be $5,000, which is your position size, divided by the entry price, which is $10,005 per Bitcoin. And that equals 0.49975 BTC. If you're trading in Bitcoin for alts, you will use the same equation to find out how much Bitcoin you should bet on your trade. So to calculate how much Bitcoin you'll bet on each trade, these are the same steps. You just look at your portfolio balance in Bitcoin. You multiply that by the percentage you're willing to risk for your trade, which is typically 1 to 3%, and you divide that number by your stop loss percentage. So here's an example to calculate your position size in Bitcoin using an account with 1.2 BTC. This is trading Link and Bitcoin together. Your trading portfolio is 1.2 BTC. Your risk per trade is 3%. Your stop loss is 8%. So you take your portfolio balance, 1.2 Bitcoin, you multiply that by 0.03, which is your risk per trade, and then you divide that by 0.08, which is your stop loss, and this is how much Bitcoin you should put onto this particular trade for Link BTC with the stop loss at 8%. And that should be all the information that you need. If you need to know how much of the particular crypto that you're going to buy, then you simply take your position size and you divide it by your entry price. So if you wanted to buy Link at, this many Satoshis, you would take your position size, which is 0.45, and you would divide that by that many Satoshis, which is your entry price. So 0.45 divided by 0.0001955 sats equals 2,301.79 Link. And that's how you calculate your lot size, or however many cryptocurrencies you're going to get. Although the good news is that TradingView helps with your position size somewhat, but you still need to calculate it on your own. But luckily for you, you get a trading spreadsheet that does that for you because you're part of the Crypto Elite community. So I'm going to show you an example of basically how to calculate all of these different things that we just went over, and we're going to do that right now. Okay, so we are in TradingView, and this is how you basically calculate your different position sizes and manage your risk. Let's say you're just looking at Bitcoin and you notice that it has some support, right here at this 9,300 to 9,450 range. So what you want to do is you want to buy at the support. Basically, you would go over here to right here, and you could see it says long position. So you would click on that, and you would click on where you want to buy. So let's say you want to just buy right there. Now it has your risk to reward ratio as 1. So that means that if it moves up, you will gain 22.43%, and if it moves down, you will lose 22.43%, and you would basically put this at a level, this is your stop loss, so you would put this at a level that invalidates your trade. So basically, you want to buy right here on the support, and you're thinking if it breaks the support, then you want to get out, because if it breaks the support, then it's no longer support. It could turn to resistance. So you want to get out. So you'll put your stop down here at below these lows and below this low, and that's at 4. Let's just make it 5%. Let's say there you go, 5%. So this is if you lose, you're gonna lose 5%. If you win, let's just put it at let's say that you think it's going to come down here and then it's going to come back up. So let's put it at like 15% so that you have a risk to reward ratio of 3. So right here, you could see that your risk to reward ratio or reward to risk ratio is 3. You're going to win 3 times as much money if you win compared to if you lose, because 15% is 3 times 5, right? So basically, if we're going through this trade, this is what you would do. You would put on your long position right here. You would plot this out. You would say, okay, I want to get out here. This is a rational level. It's the high. It's the previous highs, and it's the resistance of the long-term trend line. If it comes down, then I'm going to get out because it invalidates my thesis that this is support and support's going to hold. So I'm going to get out. So this is what I do. I go into my trading journal, and then I put all of this into my trading journal. Okay, so this is the copy of the Crypto Elite trading journal that you have available to you if you are part of the Crypto Elite community, if you have the VIP, if you bought the Crypto Mastery course and VIP group. So what we're going to do is basically just go through this. What I do is type in, Bitcoin USD. I put in whatever I'm using. So this, let's say I'm using Coinbase. So I'll put Coinbase in here. Am I longing it or am I shorting it? I'm longing it. Put the date, and then I put my average entry in. So 9,388 or 9,388.97. 9,388.97. Average. If this is blank, then it's open. What's my stop loss? Stop loss is 8,915.29. So I put that in there. What's my target? My target is 10,800. You know, I don't like putting 10 big round numbers. I like to put in 10,797, just below the actual big numbers, because everyone has their sell orders or buy orders at the big round numbers, the big psychological numbers. So just front run them a little bit, and you'll do a lot better. 10,797. So put 10,797. And how much am I willing to risk per trade? Well, this seems like it's a pretty risky trade because it kept on bouncing. So it could bounce, but it might also fall through. So I'll risk, say, 3%. So I'll put 3 right there. I'll click OK. And let's say I have $1,000 as my starting balance. My ending balance is 1,240. So this is my ending balance. This is how much is in my portfolio right now. So if I risk 3% of my portfolio of my $1,240, if I risk 3% of that, and my stop loss is down here, then my stop loss is at 5.05%, which is what it is, 5.05%. You can see that right here. So this does this all for you. This is your stop loss, and this is your reward, 15%. This, you know, if you win, and your RR is it's all calculated here. So then you put in your risk per trade, and it tells you your position size. So your position size should be $594.64 if you if you have this balance. So what you need to do is you need to make sure that this balance is the same that is, on your entire portfolio, on your entire account. My trade is not closed, so I'm not going to put this in here. My leverage, I'm just using one leverage. I'm not using any leverage, really. I'm not using any margin. So, I'll just put one there, put 100%. And that is how I calculate my position size when I'm using USD, right? So it's super easy. I just do this. And then what I do is I go into 3 commas and I just put everything into 3 commas, and that's it. It's so easy. And this keeps track of everything: the number of open trades, closed trades, your winners, your losers. So it's really amazing, and I highly recommend using this, trading journal that you got. And so that was for, a USD type thing. That was like Bitcoin USD, right? So what about if you're, for example, doing Bitcoin and an altcoin, you're trading in Bitcoin? Well, it's the same exact thing. You would plot, your graph, you would chart your technical analysis on the chart, on the graph, and this one I could see, okay, there's a lot of support right here, there's a lot of resistance right here, it's trading in this range, so I'll buy at the support and I'll sell at the resistance. So if I do that, then that means that this will be my trade, and if it falls below the support, then my trade is invalidated. So I'll have something similar to this. Looks really good to me. So this is my buy. It's right here, 196. My stop is 180, and my take profit is 239. So go into my trading journal, and what will I do? I will put ARC BTC. I'll put the exchange, which is Binance. Am I longing it or am I shorting it? I'll be longing it. And what I'll do is I'll just put in, the date, and then I'll change this whenever it gets hit. So I forgot to actually mention that. What I'll do is I'll put in the date that I, create the trade, right? And then what I'll do is I will set alerts. So I'll set an alert on this horizontal line, which is the exact price that I'm buying it at, that my entry price is, and I'll say, okay, entered ARC, update spreadsheet, and then once this gets hit, I'll go back into my spreadsheet and I'll update it with the correct date that my trade was opened. Sometimes the trades never get hit and I never actually enter them. What happens if I do that? It's, I'll just erase the trade. It's not a big deal. And also what I always do is I click publish on my trades. So when you do that, I'll click ARC, ARC trade, or I'll just, I'll just put an ARC. I'll put long, I'll put trend analysis, and I'll just put an ARC, and then I'll click publish idea. And now I have this idea actually set. So what's going to happen is this is the 1 day chart. So every single one of these candles acts as 1 day. So every single day this moves, what happens is I will be able to come back to it and click this play button and I will be able to see a new candlestick. So let's say in 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's say in 10 days is when it hits. So it hits like right around here. I'll be able to come back, click the play button, and I'll see the bars loading, and I'll be able to track my trade and really see, go back and see, oh, was this a good trade or not? Like, and not just like, was it a good trade in terms of did I win or did I lose, but is it a good trade as in like, can I use this information on another trade? Can I buy the support if I see it in this consolidation period? And so I do this and I always copy this and I click copy. And then what I do is I put it into 3 commas. I put it into my 3 commas software. So I'll just show you a quick example of that. Like when I do that, right now I have 2 trades that I'm going on. And so I have EOS and I have Dusk. So Dusk right here, you can see that this is the trading for Dusk. So I'll just click on that. And what I always do is I put in the published trade right here in 3 commas so that I can always go back and check. So what I do is I go in here and I click, new tab, and I'll be able to see my trade and see how well, what it's actually doing. So, I'll click play and now I can see, okay, so this is what it did. So I'm still waiting, for this to get hit. And yeah, that's how I put it on. So going back to this, let's finish this up. I have my ARC trade, 0.0000196. So 0.0000196 is my entry. My stop loss is 180. 180. My target is 239. So 239. And now you see that filled this in. My risk, my stop is 8.16%, which is correct. My reward should be 21.94%. 21.94%. My RR is 2.68, so that fills this in for you right here. 2.68, 2.69. That's great. How much am I willing to risk on this trade? Well, let's say I want to risk 3%, so I'll put 3 and I'll click enter. And then this is the only time that you really need to do some work is when you're trading, in Bitcoin pairings, Bitcoin altcoin pairings, because this gives you the position size in US dollars, but obviously you're using Bitcoin, so you need to know, what position Bitcoin you're going to be putting in. So let's just use an example of, say you have 1.2 Bitcoin. And you know what I'm going to do for this? I'm actually going to go into 3 commas and I'm going to put in all of this information into 3 commas as if we're actually putting on a trade so you could see exactly what's up. So here we're in 3 commas and you could see that this is the smart trade for Bitcoin ARC. I put Bitcoin in here, I put ARC in here, and I'm going to basically make a trade with it. So I have 196 as my entry price. I put a conditional market order. That's always how I like to do it, because 96 is right here, and I have 180 for my stop and 239 for my take profit. So 180 market order last as a stop, and I have 239 market order last as my take profit. This is how I always trade on 3 commas. But now we need to know, how much Bitcoin am I going to put on here? Well, if we go back to our slides to calculate how much Bitcoin you need to bet on each trade, here are the steps. Look at your portfolio balance in Bitcoin, multiply that by the percentage you're willing to risk for your trade, and then divide that number by your stop loss. So let's say that we had, 1.2 Bitcoin. So we'll just do this right here. If we have, say, your 1.2 Bitcoin, your total portfolio balance, 1.2 Bitcoin. And if we go back here, we're risking 3%. So 1.2 times 0.03. Okay. And then you divide that number by your stop loss percentage. So your stop loss percentage 8.16. So divide by 0.816. And this is how much Bitcoin we're going to be putting on this trade. So 0.4412. And so I'd go in there and I'd put in 0.4412. And that is how, and then I would, click create trade. And that's how I would create this particular trade for ARK. All right, so now you know about position size, and we'll get more into position size later, but you have the gist of it down. And you know that you need to take care of your position size. Every single time you put on a trade, you need to calculate your position size using the equations that we, just went over. So the next thing that we are going to go over is your reward to risk ratio, which is also known as RR or just simply R. This is how much you will win if you win the trade, divided by how much you will lose if you lose the trade. Most of the time, it's called risk reward and is abbreviated RR or simply R. Sometimes it's a ratio like 1.5 to 1, 2 to 1, or 4 to 1, while sometimes people just use one number like 1.5, 2, or 4. The RR is represented by the equation take profit price minus your entry price divided by your entry price minus your stop loss price. As an example, let's say that you want to buy XRP at 10 cents, which is obviously awesome. Your take profit is 20 cents. Your stop loss is 5 cents. So if you win, then the price moves up 10 cents and you will gain 100%. You'll double your money. If you lose, the price moves down 5 cents and you will lose 50%. Using the equation 20 minus 10, so your take profit price minus your entry price, divided by 10 minus 5, or your entry price minus your stop loss price, equals 10 divided by 5 equals 2. So your reward to risk ratio is 2 to 1. You will win twice the amount of money compared to if you lose if you use that reward to risk ratio. You can also calculate your RR using Bitcoin values using the same exact equation. So using, say, XRP Bitcoin as an example. If your entry price was 0.00001745, your profit level was 0.00003975, and your stop loss was 0.00001098. There's a lot more zeros in this equation, but the equation is in these numbers, but the equation is the exact same. It's the exact same. It's take profit price minus entry price divided by entry price minus stop loss price. So take profit minus entry divided by entry minus stop, and that gives you your RR of 3.45. And you could also see your RR in TradingView, and we actually went over that earlier, so no need to go over it again. Your reward to risk ratio, your RR ratios, and the effect on your trading. Okay, so this is sort of important. Your 1-1 RR ratio. If your RR ratio is 1 to 1, then the amount you win, if you win, is equivalent to the amount you will lose if you lose. That means that you need to have a win ratio of over 50% if your trades have 1-to-1 RRs in order for you to be profitable. So just as an example, this is an RR of 1, that's 1 to 1. If you win, you win 18.8%, 18.18%. If you lose 18.18%. So your win is the exact same as your loss. So you need to have at least a 50% win rate in order to, be profitable with a risk to reward or reward to risk ratio of 1. And then you have 2 to 1 risk ratio. So if your RR is 2 to 1, then the amount you win if you win is twice the amount that you will lose if you lose. This means that one winning trade with an RR of 2-1 will offset about 2 losing trades with the same RR. And as the RR gets greater and greater, you'll need less winners to offset your losers. If you put on trades only with 4 to 1 RRs, you could lose 4 of them and then will only need to win 1 trade to make up for the majority of your losses. You won't be back at break even, but with one more win at a 4 to 1 RR, you'll be back above break even. So that means that you could lose 4 trades and win 2 trades to be in profit if your RR is 4 to 1 and you keep your risk the same for each trade. So going back to this example, this is a RR of 1, but if you bring it up to, up here, then the R is 2. If you bring it all the way up, all the way up here, the R is 3, the R is 4 now. So it's like this. It's like, yeah, the R is great, but I mean, what is this based off of? You always want to base your take profit levels and your stop loss levels and everything. You always want to base it off of technical analysis. So that's why, you'll see me say that your RR isn't as important as technical analysis and putting your stops and your take profits at the levels that make sense and using correct position sizes. And that's what this slide is about. Your RR, it's not as important as your win rate and profits. So when people hear that the higher the reward to risk ratio you have, the less trades it will take to offset your losers, this makes people think that the higher the RR, the better. The problem with this thinking, though, is that usually the higher the RR, the less chance the trade has of actually hitting. So, I mean, you could have 50 trades with, the best RRs of 30 to 1. And it won't matter if none of them actually hit your profit-taking targets. You'll just end up losing more and more money. What is much more important than RR is your winning percent rate. So your RR isn't the most important thing to worry about. If you are using technical analysis effectively, your RR won't matter because your position sizes will take into account the risk that you're willing to take. So, like I mentioned, a 30 to 1 RR isn't better than a 1 to 1 RR if you don't win your trades. You're here to make money, not have high RRs. If your RR is 1 to 1, you'll just put less money into the trade compared to a trade with an RR of, say, 8 to 1. You'll also probably win a lot more of the 1 to 1 R trades. And, I just wanted to mention this because I heard a lot of people say, oh, I need to, I never put on a trade unless the RR is at least 2. And I used to get so caught up in making sure that my trades had RR ratios over 1.5 or 2 every single time. And I would lose a lot of trades. When I lowered my RR and I gave my trades more leeway, I saw my win rate percentage skyrocket. And obviously my profits started getting a lot better. So obviously this doesn't mean only take trades with 1 to 1 RR ratios or something like that, but it means don't be afraid to experiment and don't listen to people when they say you need to have an RR over 1.5 or 2 or 3 or whatever for every single trade. You need to find your style and what works for you and position your sizes correctly so that if you do lose, a trade, you're not going to lose a terrible amount of money, like a devastating amount, and just keep on doing that. So it's really up to your style. Another thing that I want to mention is that your RR should change depending on if you are in a bull market or a bear market. So taking profits in a bull trend versus bear trends, you want to take your profits at conservative levels in bearish markets, take them early, and you want to take your profits at higher levels and, let them run in bullish markets. So having a higher RR in bullish markets and a lower RR in bearish markets is basically what this comes down to. You want to track your trades to know your win rates, and you want to adjust your R ratios accordingly. Like I mentioned before, higher RRs typically equals lower win rates. lower RRs typically equal higher win rates. So it depends on your style. Obviously, for you to know whether your trading strategies are worth it, you need to track your win rate. Normally, people track their win rates over the weekly, monthly, or quarterly period. But you should definitely be tracking your win rates and see what strategies you're using and which ones they're working, because that will help you determine how much you want to risk per trade. You know, if you have a strategy that has an 80% win rate, you're obviously going to risk a significant amount more than compared to a trade that has a 40% win rate. It's up to you whether you want to be the type of trader who makes a lot of trades with high RRs so that you could lose a lot and make everything back plus more on a single win, and most likely have a low win percentage rate. Or if you want to be the type of trader who makes less trades with a lower RR, most likely having a higher win percentage rate. That is something that you have to figure out over time for yourself. Personally, I am extremely comfortable waiting for optimal setups and taking on trades with lower RRs that have a higher win rate. This is because it allows me to have more time to do other things than just sitting in front of my computer and trading 24/7. And I'm sure, if you have a job or if you have a career or if you have responsibilities, you don't want to be in front of your computer. Even if you did, you don't want to be in front of your computer sitting down 24/7 because it's not even healthy for you. So that's why I take on the higher winning percentage trades, which don't come around as often. And their RRs are not, as high as other trades. But, I take my profits and I get to live my life. And, that's just how I like to live my life personally. If you like to, be a scalper and you want to take some super high RR trades, like a million of them, then it's totally up to you. So now that you know about that, we're going to go into calculating your position sizes for multiple trades, because obviously, well, not obviously, but most likely, more than likely, you're going to be in more than one trade at a time, right? Like, it's not like you just put on one single trade and then let that entire trade play out and then that's it. Because like I mentioned, if you have, a trade that you put on, your entire portfolio is not going to go into that one trade. So you're going to have money left over to put into other trades. So this is how you calculate your position sizes for multiple trades. Firstly, you need to always adjust your position size based off the amount of capital you have after a portion of it is allocated towards a trade. And there's 4 different ways how you can calculate your position size. You could split your trades into even positions. You can calculate your position sizes via grouping. You can risk your portfolio on every single trade separately, or you could use your entire portfolio balance to calculate your position size for every single trade. And I'm going to go into each of these in depth because some of them don't make sense right now. But if you use 3 commas and you use the secret, formula that I use, then you can do some of them. So the first way to calculate your position size when putting on multiple trades is to just split your trades into even positions. So it's as easy as it sounds. If you have $10,000 in your trading account, in your portfolio, and you are going to put on 5 trades, you'll put $2,000 on each trade. It's pretty self-explanatory. The second option is to calculate your position sizes via grouping so that if you lose every single trade you're in, your portfolio won't lose more than your designated risk, which is usually 1 to 3%. So this one, let's just go over an example real quick. For multiple trades, calculating your position size via grouping, let's say that you have 5 trades and your portfolio has $10,000 in it, and you don't want to lose more than 3% as your risk per trade. If you remember, the calculation for your position size is your portfolio times your risk per trade divided by your stop loss. So let's just put this on the screen and go over it real quick. So in this example, you're starting out with $10,000 in your portfolio and you want to risk 3% per trade. So you do the $10,000, your portfolio, you multiply that by your risk per trade, which is 3%. And then you divide that by your stop. So let's say trade number 1 is a 4% stop. Well, if you do that, then that means that you will put $7,500 into trade 1, and you'll risk 3% of your portfolio if you do that. Well, for trade number 2, now your portfolio only has $2,500 in it because this is already in in a trade. So your next trade, you have to act as if you only have 2,500 in your portfolio. And then you simply just do the same equation, 2,500 times, 3% divided by whatever your stop loss. So in this example, the stop loss is, 9%, and that gives you $833 to put into trade number 2. So then you have to take 833 and subtract it from this, and that gives you 1,667. So now this is your entire portfolio balance that you have at the moment. So on trade number 3, you do the same thing, and you simply just keep on doing this every single time you put on a trade, and that will make sure that even if you lose all 5 of these trades, you won't lose more than 3%, because that's the risk percentage that you're willing to risk. You won't lose 3% on your entire portfolio. So if you lose every single one of these trades, you won't lose more than $300. And that is basically a really good way to trade if you are trading and you're unsure of the markets, or you think that, all of your trades could literally go bust and you just lose, but you still want to trade. Then this is how you would do it, so that you don't, this really, really protects your capital if you trade like this. So the first way, like we mentioned, was to just split your portfolio, as into a certain amount for every single trade. The second way is to do it like this and group every single trade, so that if you lose every single trade you're in, your portfolio won't lose more than your designated risk. The third way you can calculate your position size is to risk your portfolio on every single trade separately. With this method, if you're in, say, 3 trades and you risk 3% on all of them, and they all end up losing, you will experience extreme drawdowns. You'll lose 9% on your entire account if all 3 trades end up losing. And that's why this method isn't actually suitable for more than, I would say, 3 trades at a time. And that's only if you are using, 3% like maximum on as your risk per trade, because you can't. That's like doing this, except on trade 2, trade 3, trade 4, trade 5, you're acting as if, you still have $10,000 on every single trade. Firstly, you probably won't have enough funds to do that, but if you did have enough funds to do that, then you wouldn't want to do that for more than either 2 or 3 trades maximum, because if you lose all of them, then you're going to experience a significant decline on your account. Now, the fourth way that you could calculate your position size is actually a secret strategy that is only available if you have 3 commas and want to be in 1 trade at a time, or you want to simply put on a bunch of trades, and then whichever one hits first is the one that you're going to go into. And this is honestly, I love this about 3 commas. So this is when you use your entire portfolio balance to calculate your position size for every single trade, and then you set a conditional order in 3 commas. So if you do that, your order won't be put into the books until your entry price is hit. So what that means is that you could put in multiple trades all at once, and then whenever the first one hits, it will take up most of your balance, and the other ones will be canceled if you don't have enough money left over. So let me sort of do an example with that. All right, so now I'm in 3 commas, and this is an example. So I have $10,000 in this account, right? So let's say that I want to buy Bitcoin, USD Bitcoin at, when it reaches $10,000. So what I'll do is I'll go into Smart Trade and I'll do a conditional order. And you can see I have, 9,990, basically 10 grand. And what I'll do is I'll put, 10,000 and 5, because I want to buy it at $10,005. I'll put a market order. And what I'll do is I'll set up my, risk. I'll have my risk and everything. So let's say that I'm comfortable risking 5% of my entire portfolio balance on this. Well, I could, put 100% of my balance on this trade, and then I could have my stop loss, for 5%, and I could have my take profit for, say 10,560, and I'll put this on last, and I'll put this on last, and then I can create my trade, right? So by doing that, my trade is now successful. And you could see that I have a trade in the books and it's waiting to reach $10,005, right? The current price is $10,082. But let's say that I have another, I saw something else. I saw something in algo and I really want to buy algo when it reaches, 36 cents, 0.365 cents. What I could do is I could do 0.365 cents, right? And let's say that I want to risk 5% of my entire account on this as well because it looks like a really, really good trade. And I'm being super, super aggressive and I have my take profit, say at 10%. I'll put this at last. I'll put this at last. I could literally put that same 100% of my account, just like how I did on this trade. I could put it on this and I could create trade. And now what's going to happen is that whichever one hits first, whether Bitcoin reaches $10,005 first or algo reaches 365 first, whichever one happens first, that will initiate the order. And then I won't have enough funds for the other trade, right? So it'll automatically just cancel the other trade because I won't have enough funds available for it because all my funds will be into whichever one hits first. And you could literally put on, however many trades you want in this manner because when you click conditional on 3 commas, it doesn't actually put your money in or your order in the books. It waits until it hits this price and then it market orders it. You can't do this when you're on Binance. You can't do this when you're on Coinbase. You can't do this on any exchange, which is why I freaking love 3 commas because it lets you do this. And, to be honest, you wouldn't want to use, 100% of your account on any like one trade, but you could technically do this with 100%, or you could do this with, even like 80% of your accounts, or 70% of your account. You could do it with a lot more than you normally would, and then whichever one hits first will hit, and then you won't actually be put into the other trades, which means that you will only lose the amount that you're willing to lose on one of the trades that you put in. So that's just like sort of a secret little thing that I do sometimes with 3 commas because it lets me put on a lot more in certain trades and still, protect my capital. So you just got this super secret thing. If you want to do this, you could, do it this way as well. Okay, so now we're going to do a quick summary of most of what we covered, and then we'll get into some advanced stop loss strategies. And that should be pretty much everything when it comes to all of the basics for risk management. So for the summary, number 1, always know your entry, your take profit, and your stop loss levels beforehand. You want to plan your trade and trade your plan. You plan it out beforehand because you are calm and collective and are rational when you're not in the trade. And then if you get into the trade, a lot of the times that goes out the window and you become very emotional. So that's why you do everything beforehand. And then you just set your levels and you set them and forget them if you're using 3 commas. Number 2, make sure that your position sizes are set so that you don't lose more than 3% of your portfolio on any single trade, except for on rare occasions. So like I mentioned, 1 to 3% is the average that any professional trader will actually risk per trade. If you find an edge that works really, really well, or you're having a trade, you have a trade that you're putting on that you are just so certain that it will work, you could risk, honestly, I risk up to 10% sometimes on those it's like rare occasions though. That's when like on the daily or the weekly, I'm getting, high support. There's the bullish divergence on the RSI and the MACD. Like a lot of things add up, line up, and then I'll risk a lot more on those trades. But most of the time, especially if you're day trading or especially if you are trading a lot of those, higher RR, lower probability trades stick to 1 to 3% of your portfolio, risking that on any single trade. If you're like me though, and you like to wait for optimal entries, then you could risk a little bit more. Number 3, calculate your win rate and know which setups have higher probabilities than others and adjust your position sizes accordingly. This is exactly what I just said. And then number 4, higher RRs are great, but make sure that you are actually winning and profitable. And this is, something else I just said. So, just because you have a high RR, your trades could be good, but you might need to adjust it if you notice that you're losing and losing and losing. I mean, don't be afraid to adjust it and experiment. And with saying that, I think this is a good time to take a quick break before you get into the advanced stop loss strategy section. So I'm going to have that in another video. And so I will see you in the advanced stop loss strategy section. But like I mentioned in the beginning, this is the most important stuff. This is what you should really just practice and practice and practice and really get this down, this risk management, because this is how you're going to be able to stay in the game for, basically for life. If you really enjoy it like myself and you just want to stay in it, you got to know risk management. That's what every single, person who is a successful trader, says that they wish that they did and they wish they learned was risk management. So learn this stuff, practice it, get good at it, and I'm going to, have a lot more videos on it and a lot more examples and all of that. And then I'll see you in the next video where we are going to talk about advanced stop loss strategies. All right, guys, now we are on the advanced stop loss strategies section of the risk management series. There are a lot of different types of stop losses that you could use, so we're going to go over all of them, and then, this will help you become a better trader so that you can know, you just have more tools in your toolbox and can switch up your stop loss strategy depending on the type of market and the trade that you're doing. There are regular stop losses, there's staggered stop losses, trailing stop losses. You could simply have alerts as your stop losses. There are stop loss timeouts, which are available with 3 commas, and then there are candle closing stop losses. Because your stop loss is such an integral part of your trading, this is why we're going to go over all of these different ways that you could use your stop loss. You don't always have to exit 100% of your position if your stop loss hits. And because I use 3 commas to automate my trading, I will be going over how to use these different stop loss strategies in 3 commas. And if you don't have 3 commas, there is a link below for you to download it. Like I mentioned before, I don't recommend trading without 3 commas because it literally gives you all of the features that you need in order to be successful. So let's just start off with the regular stop loss. Okay, when you set a regular stop loss, your trade will be closed when the price falls to or below the price that you set. For example, if you buy 1 ETH at $100 and you set a minus 10% stop loss, then your trade will close if the price hits $90 or, minus 10% from your entry. A second way you could use a stop loss is to lock in profits. So say you bought ETH at $100 and the price moves up to 120. You could set your stop to 110 so that if the price dips back down to $110, you'll lock in your 10% gains. The wider you set your stop loss, the less money you should put into your trade. This is because if you have a really wide stop loss and it gets hit, you don't want to take a huge loss to your account. But if you have a tighter stop loss, then you could afford to get more. You can afford to bet more because if you lose, then you won't take as big of a hit to your account if your stop gets hit. Finding that perfect balance between position size and stop loss percentage is something that you will need to figure out and will be based off of your particular risk tolerance. Personally, I like to have, wider stops and just use smaller position sizes, but, it's totally up to you. And honestly, it's on a trade by trade basis. If I see that there's a trade that really should bounce at a particular level, then, I'll put on a lot more and I'll have a tighter stop. And I'll just throw this up real quick. This is a trade for EOS, as 11.62, and with a regular stop loss, you would just simply set your stop loss for this level right here, and, right when it hits, you're just going to get out. You're just going to sell everything, and you'll be done with the trade, and that will be it. And that is what just a regular stop loss is. Another way you could have a stop loss is by staggering them, so you could stagger your stop losses. And when you do that, you might sell 25% of your position at minus 5% from your entry, another 25% of your position at negative 10% from your entry, another 25% of your position at negative 15% from your entry, and then the final, 25% of your position at negative 20% of your entry. You could also stagger your stops if the price moves up also. So for instance, if the price moves up, say 20% from your entry, you could set it so that you'll exit 50% of your position if the price moves back down 5%. And then you could set the rest of your stop in case the price moves down 15%. This would lock in 50% of your profits at 15% above your entry, and then the other 50% of your profits at 5% of your entry. So if we go back to this example, you might say that you want to take 25% out if it hits below the 38.2, and you might say that you want to take another 25% out if it goes below the 61.8, and then you might want to take like the rest out if it goes below the 78.6 and this, resistance level right here. So that could be like staggering your stops, or if the price, decides to move up, like, say it moves up like this. What you could do is you could raise this stop. You could raise your stop all the way up to, say, right here, and you could take like 5% out here. You could take another 5% out here. You could take another 5% out here. So that way, in case it does dump, you'll be selling it, along with the dump, and at least taking some profits in case it comes all the way back down. Not something that I really ever do, but it is an option. And since we're on the topic of stop losses, I just want to mention something. This is setting your stop at break even for a quote unquote risk-free trade. So this is a strategy that you might hear from different traders. This is something that I actually don't recommend. The crypto market, it's extremely volatile. The price could easily move 4% up from your entry and then move back down to your entry and then move 40% up. So if you raise your stop to break even to quote unquote protect your capital too early, then you could lose out on huge gains if the price pulls, this sort of move. I would only recommend bringing your stop to break even if the price is well above your entry, and it should not come back down unless the trade becomes invalidated. When you initially put on your trade, you set your position size according to the amount of risk that you're willing to take. If the price moves to your original stop loss when you first make the trade, you should already know what will happen, and you should already be okay with that. If you are okay with your original stop loss, then I don't really see why you would risk potentially missing out on profits by raising your stop to break even before the price moves up significantly. And even if it does move up significantly, it may be a better idea to bring your stop loss to at least 5% above your entry or a few percent above your entry so that if it does come back down, at least you'll get some profits. Another strategy when it comes to stop losses is the trailing stop loss. So trailing stop losses automatically follows the price of a coin. For example, if you buy one ETH at $100 and set a trailing stop for negative 10%, then a few things will be put into play. So let's say that, we're looking at this right here. Let's say that you got in, at the moving average right here. And so this was your trade, and it bounced. So that's great. And it's starting to move up. Awesome. I mean, if you bring your original stop, which is down here, which you already, you pre-planned and you planned and you know exactly what's going to happen if it hits your stop and you're okay with that. If you bring that up all the way to right here, right now, like it only moved up. Yeah, it bounced, but it could literally do so many, it could literally come back down here and then bounce back up again, or it could have a fake out or a fat finger or just a stop loss hunt or something. When if you would have kept your original, if you would have just kept your original stop where it was, all the way down here, then you wouldn't have gotten stopped out if this was to happen. Maybe if it comes all the way, if this is your original trade and it comes all the way up here, and then it comes up and it forms some sort of, it forms some sort of pattern like this, like a triangle, like a bullish triangle pattern, then maybe you want to, at that point, raise your stop to break even or just above break even, in case it falls all the way back down. And, I don't even know if I totally recommend even doing that, simply because when you do your, like, you should be good enough to do your own analysis and know where the price is going to hit, you know? Like, you should have, for instance, one of your take profit levels like right here at the 61.8, and you should have another one of your take profit levels, you know, right here at the negative 100, and the big time resistance. So I just don't really see the point in bringing your stop all the way back up to break even. You know, when I make my trade and I set it and I forget it. And it's like, if it hits, it hits. If it doesn't, it doesn't. But like, I don't want to potentially lose out on a lot of profits, because these swings are super volatile in the market. It could literally just like go like that, you know? You never know. So that's when it comes to raising your stops. It's not a bad idea if it comes all the way up here, but I mean, I just like to leave my trades how I create them when I plan them originally. Another strategy when it comes to stop losses is the trailing stop loss. Trailing stop losses automatically follows the price of a coin as it moves up. For example, if you buy 1 ETH at $100 and you set a trailing stop for negative 10%, then a few things will be put into play. Firstly, if the price moves down 10% to $90, you know, your order will automatically sell because that's where your stop loss is. However, if the price moves up, then your stop loss will follow the price. So if ETH on this particular trade moves up to $105, your stop will now be at negative 10% of $105. So if the price decides to drop down 10% from 105 and hits $94.50, that is when you will exit the trade. As the price continues to move up, your stop will continue to trail the price until there is a large enough drop so that your stop gets activated. And 3 commas actually has a really good video on this, so I'll show you that. This is the 3 commas site, and it basically shows you, okay, you could, you know, click trailing stop in here, and it does it automatically for you, which is really, really cool. And then it says, you know, you buy it at 100, your trailing stop starts at 90. As it continues to rise, your stop loss continues to rise with it. And basically this is the thing right here. This is your buy level. You say you buy it right here and you put your stop right here. As the price moves up, your stop loss continues to move up. And until the price moves down, your stop loss will remain at the level that you set it at until the price moves down and it hits. So it hit right there, and now you're out. And it's a cool feature. Honestly, it is a pretty cool feature. I don't really use it because of the volatile swings in crypto, but I can see why some people use it. It might end up fitting your trading style pretty well. Maybe in like really, really big trending bull markets, you might want to use it, or in really, really trending bear markets, you might want to use it. But for the most part, I just set my take profits at particular levels. I set my, you know, stops at particular levels, and I just put my trade on. But this is a pretty cool feature that 3 commas has. So there is the trailing stop. One thing to note with the trailing stop is that your stop will rise when the price rises, right? But it will never fall as the price falls. So, for example, if you buy ETH at 100 and set a negative 10% stop loss, trailing stop loss, and ETH moves up to 110, your new stop loss will be 101. If the price goes down any amount from 110 though, your stop will remain at 101 until it's hit. If it is never hit and the price moves up to, say, $140 though, your price will continue to move up to match the rise, and your new stop will always be negative 10%. So if it moves up to 140, then your new stop will be negative 10% from $140. So your new stop would be $126, and your stop will not go down from 126. It will either hit it, or it will continue to move up as the price continues to move up. Typically, 3 to 5% is the typical trailing stop percentage, although you could always make it bigger depending on your particular trading style. Like I said, personally, I don't really use trailing stops. I prefer to just take my stops at predetermined levels. A lot of times, because of the volatility of crypto, trailing stops could actually end up working against you and have you exit a trade too early because the price might have a wick down, stop you out, and then run up again. So that is trailing stops. And then this is exactly what I just said. So another strategy that I like for stop losses is just using alerts, so stop alerts. Like I just mentioned, a lot of the times cryptocurrencies will experience something called stop loss hunts by big whales and institutions. This is when the big player sets big buy orders where most people have their stops. Then they sell a big portion of their crypto and they drop the price to where everyone has, their stops set. And then they stop everyone out. And since they put their buy orders down at those same levels, they automatically buy up the crypto they just sold, and move the price back up again. So basically, they just get more and more crypto. To make sure you aren't on the losing end of a stop loss hunt, you could actually just choose to set alerts instead of actual stop losses into your exchange, or 3 commas. Then when you get the alert, you could keep an eye on the market and determine what you want to do. This is typically what I like to do. I will set my alerts and then I'll wait until the candle closes. Usually I like to use the 4-hour candle for trading and if it closes below my stop, then I'll get out. You could also set alerts at specific levels, and then if they get hit, you could lower your take profit so that you could get out on a bounce. This is another strategy that I like to do. It's pretty advanced though, and it does require you to have a good grasp of trading. So I'll show you an example of it. All right, so let's go back to this example, and I'm actually doing this example because this is the trade that I'm in right now. So let's say that you got in at the EMAs, right? And you have your stop loss underneath the 78.6, and your take profit is up here. So what we're trying to do is stop alerts. What you could technically do is say that this failed and this came all the way down here, and it would hit your stop, right? But what you could do is you could right click and you can simply set an alert to go off, and you could say add alerts at this level, and you could say, stop hit, check on trade, and lower take profit, right? So if this happens and you understand where there's like support and resistance levels, now the price is all the way down here. So you could just simply take your take profit and bring it down here to the last resistance/support levels, and then you could hope that there will be a bounce and you could get out, out here, because now this level where you originally got in, which was the support, is now the resistance. So you could hope that there will be a bounce and it will hit that resistance and you could get out there. Obviously, this is a risky thing because, a lot of the times it bounces, but it never actually hits that level. And then it just keeps on going further down. So it ends up going even further down than where your original stop loss was. So this is sort of like a very advanced concept and pretty tricky to get down. But you could do that. And you can also have it so, there's a lot of things that you could do in this situation. You could do this, and then you could have buy orders down here and hope for another bounce, and then, lower your take profit down here so that technically, if it, you'll never actually lose a trade, but, and take a significant loss if there is the bounce. But, that's just the thing. There has to be a significant bounce. And sometimes there's not a bounce that's like as significant. But this is an example. This is like what I'm saying. Let's say you put on a trade, you got in, you got in like right here because you saw that this was, this had a nice bounce, and then you got in at the retest, like right over here of this area, and your stop was below this low right here. So it hit your stop, obviously. Well, what you could have done is you could have set an alert right here at this level, and then if it, when it failed, it would have came all the way down here, your alert would have went off, and then you would have lowered your take profit down to the, down to this, this level, the swing low, which is the new resistance, support/resistance now. And then you would have saved, like 3%, as opposed to just getting out, like right here, or getting out like right here. And you would have saved, like a few percent. Is that worth it? If you're not in front of the screen, you can't really do this. It's super advanced, and sometimes you might end up losing a lot more. So I would recommend just getting out. A lot of the times I would recommend getting out, but it totally depends on the market, the coin, the trade. There's a lot of different factors that go into if you want to do that, because if you do it right, it can end up saving you a lot of money. Like, it has saved me a lot of money when I've lowered my take profit down by setting alerts, and then I usually get out when there's a bounce. But like I said, that's something that you will need to experiment with on your own. Another stop loss strategy is the stop loss timeout. Now, this is only available on 3 commas, so you need to, download and have 3 commas in order to use this feature. And this is where you watch out for stop loss hunts and fat fingers by having a timeout on your stop. With a stop loss timeout, you set your stop loss, and if the price hits your stop loss, then the system will wait a specific amount of time before it sells your position, depending on some factors. If you set the stop loss timeout for 2 hours, then the system will check the price 2 hours after your initial stop was hit. If the price is below your initial stop, your trade will be closed at whatever price it is at that time. And if the price moved back up and is above your initial stop loss when the system checks it at the 2-hour mark, your stop won't be activated and you will remain in the trade. This is the stop loss timeout on 3 commas. You could just click the button right here, stop loss timeout, in your stop loss section. And like it says, if the price drops, to or below your stop loss level, then the system will wait for a specific amount of time, in minutes. And then after this, it'll do an additional check of the price. If the price is still on or below your stop loss level, then the trade will be sold by the stop loss. And if the price rose back above your stop loss level, then the trade will remain open. And if it goes back above it, then it'll remain open, and then it will reset. So basically, if the price comes back down and hits your stop loss again, it will take another, in this case, 5 minutes before it will check again and, do this whole thing. So this is really, really good to protect you against fat fingers and like quick spikes. And it's not a bad thing. I don't usually do it, but it sort of depends on the market and stuff. I don't usually do it because I like to trade on the 4-hour. So you have to be sure to use the same, time limit that you're looking at, basically. Depending on the time frame that you use to plan your trades, that will determine the time that you allocate to your timeout. If you're scalping, a 5-minute timeout, it'll work. If you're trading on the 4-hour, then a 4-hour timeout would, be more appropriate in my opinion, because you want to wait for the close. At least that's what I do, and we'll get into that in just a second. And just in case that wasn't totally clear, here are some examples for the stop loss timeouts. Basically, if you buy 1 ETH at $100 and you set your stop loss timeout for negative 10% with a 60-minute period, then if the price moves down to $85, your stop loss timeout will be triggered and the system will check the price in 60 minutes. During that 60 minutes, the price moved up to, say, $96. The system checks at the 60-minute mark, sees the price is above your initial $90 stop loss, and you will remain in the trade. Here's another example. Example 2, you buy 1 ETH at $100 and set your stop loss timeout for negative 10% with a 60-minute period. The price moves down to $85. Your stop loss timeout is triggered and the system will check the price in 60 minutes. During that 60 minutes, the price moved down to $82. The system checks at the 60-minute mark, sees the price is below your initial $90 stop loss, and it closes your position at $82. You could see that in this scenario, you ended up taking a bigger loss than your original negative 10% that you put down. But in example 1, you ended up actually not taking the loss at all. So stop loss timeouts, they work good in different scenarios. And then finally, the last stop loss strategy is the candle closing stops. Now, I alluded to this a little bit when I talked about the stop loss alerts and also, just like the last slide. This is when you trade based off of a candle body closing. So when you trade based off of candle body closing prices, you will only get out of a trade if the candle's body closes below your stop. I like this because it sort of ensures that you won't get stopped out if there's a fat finger trade or a stop loss hunt. What I do is I set an alert at my stop loss. Then if the price hits that level and my alert goes off, I will wait until the body closes And usually I like to use the 4-hour chart. And I will only exit the trade if the body of the candle closes below my stop. I like this strategy because it gives time for the market to correct itself and really determine if it actually wants to go down or if it was just, some quick selling before a spike up. With this strategy, you have to make sure that you're using the same time frame that you used when you made your trade though. I mean, I remember a trade that I lost because I used the 4-hour to create the trade, but when my alert for my stop went off, I used the 1-hour candles to determine whether or not I was going to stay in the trade. Well, the 1-hour candle closed below my stop, so I got out. But then the next 1-hour candle moved up and closed above my stop loss. And after 4 hours went by, the candle ended up actually not closing below my stop on the 4-hour chart. It then reversed and it went up. I ended up leaving that trade at the bottom of a correction because I used the wrong time frame to determine whether I would leave my trade or not. So always use the same time frame you use when determining and planning your trade on whether or not you're gonna, exit that trade. And if you're trading on the 1 hour or below, it's probably a better idea to just use a regular stop loss and not necessarily wait for the candle to close, because levels for shorter time frame trades tend not to be as significant than the higher time frame trades. So that means that there's more of a chance that the price will close below your stop on the shorter time frame. And since that's the case, you might as well just get out as soon as your stop hits if you're using, the 5-minute or 30-minute or 1-hour charts, stuff like that. Going back to this example again, let's say that this is my stop right here, this line, and let's say that the price comes all the way down and then, it comes down on the 4-hour, but then it comes back up and it actually closes, it closes right here. So this is just a wick. I wouldn't actually leave my trade unless it comes back down and then closes down here. If this is where my stop was, I would stay in my trade, even though my stop was technically hit. It was hit, if it was hit by a wick and it wasn't hit, by the body and and the body doesn't close below it, then I would stay in my trade. And that's how you can use your, alerts and a closing body candle stick for your trade stop losses. And because I use 3 commas, I want to go over the 3 different types of orders, which are the bid, the ask, or the last price for your stop loss. And basically in 3 commas, you have the option of setting your stop losses and your entries and your take profits based off of the bid prices, the ask prices, or the last prices. Just to go over this, the bid price is the price that the buyers are bidding at. So if you set your stop loss at the bid price, you'll get filled when someone offers to buy your coins at your set bid price. And then there is the ask price. So the ask price is the price the sellers are asking for. If you set your stop loss at the ask price, then when the last price hits your stop limit price, your order will be placed and you will sell at the current market value, which is the closest bid price. So you're not actually going to sell at, the ask price that you set. What's going to happen is as the price moves down and then finally more sellers, are entering the markets, and then finally a seller, says, all right, I'm going to ask for this price. Once your stop limit that you set for at the ask price gets hit, then it will sell your coins at the current price that the closest bidder is looking to buy. So it might be off a little bit, and so I would never use an ask price as my stop limit price. It just doesn't really make sense. And then finally, the last price. The last price is the price that the coin is at. Sometimes the bid may be below the last price, and sometimes the ask may be above the last price. And personally, I like using the last price for basically all of my trades, including my stop losses, my take profits, and my entries, because I find it to be the most accurate representation of what the chart shows when I do my analysis. And just to show you what all of that means, basically, it means, this right here, you have the opportunity to do bid, ask, last for your stop loss or your take profits. So yeah, I like to do the last price. just because there could be some slippage and disparity between the different bid and the ask, but the last seems to be the most accurate. And I also always do a market order so that if the price reaches that level, then my stop will be triggered at the current market rate. It might be a little below the actual price, but it usually actually doesn't result in too much slippage unless the coin has very little volume. But I mean, for 99% of the people, just doing this, is not going to be an issue. Also, something to know is, how you should adjust your trading style based off of bull markets and bear markets. In a bull market, the prices of coins, they continue to go up. That means that the price is above the moving averages and the price continually prints higher highs and higher lows. You should be able to create an upward channel that connects the lows and the highs in a bull market. So as an example, you could see right here, this is a bull market. It's, constantly above the EMAs, and you could draw a parallel, you could draw a channel that is very, very clearly in an upward, an upward market, right? So this is not really the best channel, but it is what it is right here, right? So, you could see this is the channel, the high, the low, higher low, higher high. This is in a bull market, right? So going back to this, if you get into a trade and the price moves up and the price, the markets are in a bull trend, that is probably the only good time to use a trailing stop. And in this situation, you would want to keep your positions in your trade for as long as possible. To do this, you may decide to stay in your trade and simply continue to move your stop to below the most recent swing lows or below key supports that are formed as the price moves up. This could be the recent lows, below the moving averages, below particular Fibonacci levels, like the 61.8, or other key levels that you see on the chart. And if the price makes a lower low, that's usually an indication that, at least for the current period, the trend is over. And that's why you would want to get out. That's when you would want to get out. So just as an example, like we just mentioned, this is a bull market, right? So what you could do is say, put on a trade where you would get in, you would come up, print the higher high, print the lower low, print the higher high, create the supports, and say you want to get in, I don't know, at the support right here. So you would get in like right here at the supports, and then it would bounce, it would create a higher low, a higher high, a higher low. And then this would be your, this is where basically you would put your new stop, would be below this low, right? Because this was the low, this is where you got in, and then printed a higher low, and then it printed a higher high. So if it comes all the way down, it will invalidate, your thesis that this is a bull market. If it comes all the way down below this low, this higher low, the first higher low. So obviously it went up and it created a new high, and that's awesome. So where would you, put your next stop? You would raise your stop level to, say, right here, which would be below all of these lows. Because if it comes all the way down and makes a lower low, then it's not in a bull market anymore, right? And what happened was it came back down, it made a higher low. You could either keep your stop here, or you could raise your stop, to this level right here once you saw that this was sort of consolidating, right? And then once it moved up again, made another high, and then it came back down and then started to come back up, you would raise your stop to below this low. And basically you would just raise your stop below the lows, and then made a new high over here. So you would raise your stop up here, every single time that it sort of made just a higher high, higher low pattern. You would just continually raise your stops, and maybe you would raise your stop at this point to right here, because it would come up, you would raise this, you would see this, and then you would say if it drops down below this level, then you would get out, or you could have kept it down there. Either way, if you did it right here, then you would have got stopped out right here. If you kept it down here, then obviously you would have, well, I mean, at this point, honestly, you would have drawn the channel. You should have drawn the channel, and you should have had it below this, like below the channel. Like it should have just constantly been below this channel, right? And then right here, this is the 200 EMA, so it should have been like it should have been below there. So I mean, if you were keeping up with it, you wouldn't have gotten stopped out. And then basically made a higher high and then a low, and then so this is where it would be. And then once the price went all the way up here, you would raise your stop again, and basically you would just keep on raising your stop over and over and over again. And then when it hit this one would be very indicative, because this would be the first actual lower high. And like, look, right when it made the first lower high, boom, it came down. And also, if something goes parabolic and it comes out of the channel like this did, that's sort of like an indication that people are just going crazy, and you might want to take your profits, at that level, because usually it wants to come back down at that point. But I wouldn't take all of my profits here. I would take maybe 25%, and then continue to trail my stop loss. Anyway, that is the trailing stop loss in a bull market. And now, trailing your stop in a bear market, if you are shorting, I mean, honestly, a general rule I go by is that in a bull market I long, and in a bear market I short. So in a bear market, the prices are below the moving averages, and the price continually prints lower highs and lower lows. You should be able to create a downward facing channel that connects the lows and the highs in a bear trend. And if you short, you could trail your stop above the recent swing highs. So it's literally the opposite of what we just went over. Once the price makes a higher high, that indicates that the trend is changing, and that could be a good time to get out. Each lower high that is formed becomes the new quote-unquote support in a bear trend when you are shorting. You can trail your stops above each lower high to lock in your profits in a bear market. All right, so if we look at Bitcoin over here, this is obviously the bear market of 2018. And what you could have done is you could have noticed that there was the high, and then there was the low, and then there was the lower high. So eventually we made a lower high. This would have been extremely confusing, this entire area, because technically you could have said that we made a high, a low, a lower high right here, and then a lower low right here, which would have been the start of the bear market. And then this pump right here, honestly, I believe this was a manipulative pump from BitMEX and Tether. So you can't really count that. But what you could have ended up doing is eventually creating, seeing that we're in a bear trend, we would have hit this level and then gone up. And then this is where I started to realize, okay, we're going to short. So where are we going to short? And I always like to, short the 61.8. So this is what I would have done. 61.8 is right over here. So I would have shorted. And this would have been this right here would have been like the entry, right? This is where you would have initially shorted. So let me change that to red and put it like this. So let's say that you shorted right here at the 61.8, okay? Well, what happens is the price would have come down, and I wouldn't necessarily even count this as a lower low. I mean, as a lower high, but you could have. And then you could have said that this is a lower high. So these are the areas, I'm going to point out the areas that you could have your stop losses. You could lock in your stops, in profit above this area right here. It comes down, makes a lower high above this area right here, lower low, lower high. You could have locked it in right here. And by lock it in, I mean you could have lowered and trailed your stop in this bear market. Down, 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 down. Give it a little bit of wiggle room above the lower highs, but that's usually what you want to do. Lower high, come down here, made another lower high, so you could have locked in your profit right here, and then came down, came up, made a lower high right here. Maybe right here. Probably not. Down, up, down. It's made another lower high. So you would have changed it to right here, or I guess I'll just, add another one. And this would have been basically the same. This basically would have been the same level. And then, as soon as it came up, boom, your stop would have been triggered right here. And if you got in at the 61.8, so like right here, that would have locked in around 30% profits if you, put it in right here. And if you did that, on like, say 10x leverage, then you would have gotten 300% gains on that. And let's see, you could have technically done the same thing right here. Take the Fibonacci top to the bottom, get in at the 61.8, and let me get rid of all of these. So could have literally just done the same exact thing right here, gone at the 61.8, shorted it, made a low, and then a lower high. So you would have, and then once it started to come down, once it started to come down from here, you could have lowered your, stop to right here. And then basically I don't really see a lower high, any real lower highs formed. I guess right here is probably the only, you could make a case that right here is a lower high. And if you did that, then you would have eventually gotten stopped out a few days later, and then it came up, created a lower high compared to this if you were just doing this. So you would have gotten right here. I mean, put your stop, trailed your stop to right here above this lower high, and then came back up. This is a lower high, so you would have trailed your stop right here. Comes down, lower high. I guess you could have trailed your stop right here, as if you wanted to count this as a lower high. Down, up, lower high right here, so you've trailed it right there. Down, up, yep, pretty much lower high right here, so you would have trailed it a little bit right here. Down, up, yeah, pretty much a lower high right here, so you would have trailed it, would have lowered it again to right above this one. Down, up. If you didn't get hit right here, then you would have eventually gotten hit right here when it had the spike. And if you did that and you started out, at the original, at your original place, and you just did the lower highs, just kept on lowering your stop, that would have been eventually, a 40, nearly 50%, 48, 50%. Yeah, so 50% win right there, 50% gains. You put that on 10x leverage, say you put that on 10x leverage, that's 500% gains. Although I'm mentioning, if you put it on 10x leverage, that's 500% gains, and that sounds like incredible, right? But if you would have put that on 10x leverage, and let's say it had a little wick, and it literally just did this right here, then your entire account would have been wiped out. Like everything that you put into that trade would have been completely wiped out, and you would have been liquidated if it moved up if it just did this, That's why I don't really like doing leverage. Like if it would have just boom, you would have been done. You would have been toast. Luckily it didn't, and we were in a bear trend, lower highs consistently, so it made sense to short the market here, to short the market right here and right here at the 61.8s. And you could have done that, but obviously you wouldn't have put you don't want to put your entire account balance on a leveraged position like this, you know? So you would have got, yeah, you would have got 500% gains, but it wouldn't have been 500% gains to your entire account. And I sort of just want to, you know, emphasize that, because I think a lot of people, they think that, oh, I have, you know, $1,000 and I'm gonna make 500% gains, so I'm gonna have, you know, $5,000 or $6,000, you know, once I do that. But that's not necessary. That's not actually the case, because you're not going to put your entire $1,000 portfolio, if that's, you know, what you have, on the trade all at once, and leverage it to $5,000, or leverage it to $10,000. I mean, you're not gonna do that. You would put maybe a few $100s on the trade, and then leverage that up to $1,000. So it's a little bit different, but I mean, still, all in all, following this, you would have won. You would have won big. So it would still have been an incredibly good trade. So when we're in downtrending markets like this, you know, like what we were, then definitely shorting it is the better opportunity. And this is what you should do after big parabolic run-ups. Like, we're probably going to have another big parabolic run-up like we had in 2017. We're probably going to have another parabolic run-up again. And then when everyone FOMOs in, now you are more aware. So when it happens again, you know, you want to start shorting it, you could do that. Because like I mentioned, I don't like to short in bull markets. Like right now, we're in a bull market, so I'm not going to be shorting it. You know, like, if I'm going to short, if I do decide to short in a bull market, it's going to be very short lived. It will not last a long time. Like, I will be very, very, very conservative if I am shorting it in a bull market like this. I would be more aggressive in a market like this after we've already had like this. It's like downtrending, and like, okay, it's clearly in a bear market right here, you know. But I wouldn't short in a bull market like we have right here, unless you want to go down into, say, the 4-hour charts or the 1-hour charts, something like that. You want to scalp, but that's not my style. My style is swing trading. So the only time, like right here, we're in a consolidation period, right? We're creating a triangle. So you could technically create something like this. And what you could see is that there were lower highs. So yeah, we made a high, we made a low, and we made a lower high, right? So at this point, maybe you want to think, okay, well, I could start to short around this position, or I could start to short when we make whenever we bounce off of wherever we bounce, I'll short at the 61.8 of there. So, you know, you would short like right here, say, and to be honest, you'd probably have your line drawn more like this, because it would connect, you know, these 2 points. So you would say, okay, this is the resistance. It made a lower low. It made a lower high right here. This is the resistance connecting these 2 points. It matches up with the 61.8. So I'm going to short right here. And then you would have, say, at the 78.6 is where you would have your stop. So you would either get, like, right above the 78.6, so you would either get stopped out literally at the very, very top, or you would simply just be in your short until we make a higher high. So it would be all the way up here. So you would not put a whole lot of money into this trade, because that's 13%. But you would basically take your profits down here at 21%. So you would technically still be in the short. And if you did get into this short, then you would lower your stop once we started making lower highs to above each consecutive lower high. And so you would have got stopped out right there. And that would have been pretty solid 7%, 8%. And if you would have used leverage, like I mentioned, in bull markets, if I short, which I don't really do, I would use like 2x leverage or 3x leverage or maybe 5, but I would never, ever, ever go above 5x leverage in a bull market if I'm shorting it. In a bull market, if I'm going to long it, I'll do freaking 10x leverage. That's cool. And so that's basically how you would trail your stops in a bear market or if you are shorting it. All right, so now we're finally getting into the 4 types of stop losses. These include chart structure stops, volatility stops, time stops, and measured stops. Basically, you could apply stops in a lot of different ways. Each of these ways are valid. Setting your stop based off the chart structure basically means that you're setting your stop based off of any of these things: support and resistance levels, moving averages, supply and demand, swing high, swing low, Fibonacci levels, any of that stuff. Really, each of these different things are just more tools that you could use to set your stops, and it's really up to you to determine, where you want to get out on each particular trade. The more you understand about the different chart patterns and the different indicators, then the more tools you have to be able to set your stops at different levels. Most of the time, I like to use the Fibonacci and the support levels like swing lows to help guide me where I'll put my stops. The key here, though, is that you set your stop wherever your trading thesis becomes invalidated. So if you're playing a support and the price closes below your support, then your trade is invalidated and you should get out. If you are playing a bounce at the 61.8, but the price falls through it, then your idea was wrong and maybe you want to get out. If you're trading a certain chart pattern and the price moves away, or the price moves in a way that invalidates the chart pattern that you're playing, then, well, your idea is invalidated and you should probably get out at that point. And that's pretty much what stops do, is they help you get out when your idea and when your trading thesis becomes invalid. All right, so here's an example of placing your stop based off of the chart structure. This right here is the weekly graph of Bitcoin, and you can see it came all the way down and hit the 200-week moving average. So what you could have done is simply, longed at the 200-week moving average whenever it hit, and you could have just placed your stop basically, right underneath of it by, 5-10%. And that could have been your stop based off of the chart structure of the moving average. And we already went over the swing high, swing low patterns. So, let's say you got in, I guess, right here because you saw it was a lot of support. So you got in at the support. You would put your stop, below the support, just the swing, basically, which is the swing low. And so that's using the support levels. And then you could always just raise your stop loss above the, the higher lows, and that's how you would trail your stop based off the chart structure of the supports and the higher lows. You could also base your stop off of the chart structure of the Fibonacci, which is something that I like to do a lot. So take it from the bottom to the top, get in at the 61.8 right here. I'll make this green because we would technically be getting in. And then, set your stop loss below the 78.6. And that could be a good stop right there based off the chart structure of the Fibonacci. And so those are the different ways how you can, place your stop based off the different chart structures. Along with chart structures, you can also place your stop based off of the volatility of the market. Basically, you should alter your stops based off of the volatility of the market. If the market is in a tight consolidation zone and you're thinking that the price will break upwards, well, then you want to have a very tight stop below that consolidation zone. This is because the tighter the price coils, usually the more violent the move will be when it finally breaks its structure. So having a tight stop in this situation is going to protect you from large moves if it goes against your thesis. When your stop loss is very tight, that decreases the chances of your trade actually winning, but it allows you to increase your position size because if you get stopped out, you'll lose less of your portfolio if your stop is very, very tight. In tight trading ranges, if you do get in, you want a tight stop loss because the price tends to move violently in whatever direction it chooses when it finally breaks that range. And opposite to tight trading ranges is obviously wide trading ranges. So when the price is very volatile and it's experiencing large fluctuations in price, it makes more sense to have a much wider stop because your chances of getting stopped out are higher when the price is fluctuating so much. Remember that when you have a wider stop loss or when you have wider stop losses, you should have smaller position sizes to make sure that your reward to risk ratio makes sense. Another type of stop loss is the time stop. So whenever you put on a trade, it should be based off, an idea that you come up with based off of technical analysis and probably also fundamental analysis if you're combining the two. And sometimes what will happen is you will think that the price should, make a big move, but it ends up not really doing anything. If that happens, then you can and probably should just simply get out of your trade. For instance, if you see that there's a triangle forming and you expect the price to have a really big move once it reaches the apex of the triangle, but the price sort of just ends up continuing going sideways or dulls out, well then that invalidates your trade idea because it didn't have that, spike out of the apex of the triangle. So if that happens, you can then exit the trade and then come up with a new trading idea based off of the information on the chart. Remember, your stop is based off of an invalidation of your idea, so if, the market moves in a certain way that you weren't expecting, then this type of situation, it invalidates your idea. So it's a good idea to just exit the trade at this point, come up with a new, plan, a new thesis, and then put on a separate trade. And then finally, there are measured stops, and this is where you just set the same stop loss for every single trade. So, you have the same exact risk for every single trade. Usually scalpers like to do this like with 1 to 2%. Swing traders, sometimes they do 4 to 10%. You need at least, though, a 1-to-1 R if you do this, because if you risk a certain amount per trade every single time, then if you have an RR under 1, then you're going to need to win, well over 55% of your entire, all of your trades in order to be profitable. So a lot of people like to do this. It's not really something that I like to do. I like to set my stops based solely off of technical analysis. So I wouldn't just say, 4%, here's a stop at 4%. I would always base it off of TA, underneath the supports or underneath moving averages or something like that. And I just want to have some final words. Basically, without risk management, losing your portfolio is inevitable. This is called the risk of ruin, and it is the probability of an individual losing substantial amounts of money through investing, trading, or gambling, to the point where it is no longer possible to recover the losses or continue. Most people just keep adding more and more money to their accounts, and they just keep losing over and over again. You need to tattoo risk management concepts like the ones that we went over in this video into your brain so that you take your risk of ruin down to 0. Some other concepts that are really important are that you aren't a trader, but you're a risk manager. Find your edge and only go heavy on more surefire trades that have high win rate percentages. Have rules for your trades. I have a checklist that I give to everyone in the Crypto Elite group that you could go over for every single trade if you want to use that. Try to find the common factors between your winners and your losers and take notes on your trades to figure that out so that you could do more trades that are more winners and you could stop doing so much of the losing trades. You want to set your entry, your stops, and your take profits all before you enter the trade. You want to do all your TA beforehand. You don't want to just jump into stuff nilly-willy. If you're scared or you're overly emotional, if your stop hits, then you could just lower your position size and, do that until you have your emotions under control. Also, don't borrow money to trade. This means borrowing money in real life, but it also means borrowing money on the exchanges like BitMEX to trade with super heavy margin. Only after you have a clear understanding of proper risk management, what we covered in this series, then you could try margin trading and, whatever you decide to do, it's always your responsibility. It's always up to you. I just think that, I just know margin trading, it's the number one way that most traders lose money, and that's why I don't recommend it until you become very knowledgeable in trading and, you get this down. Finally, if your trade becomes invalidated, you could just get out. Don't be afraid to just get out. If the market does something that changes your analysis, or you catch something like a bearish divergence on the RSI after you put on your trade, or you come across news that makes you uncertain, just get out. It's not a big deal. There'll always be another trade. If you see Bitcoin is about to crash and you're in altcoin trades, you can also exit your altcoin positions, because a lot of times most of the time crypto markets are correlated. So if Bitcoin crashes 5%, altcoins could crash 10% or 15%. So if you see Bitcoin's gonna dump, you might want to get out of all of your alts. And finally, if you're expecting a bounce and you get it, but then the price comes back down relatively quickly, the probability of your original trade, it gets lowered. So you might want to, decrease your position size on that trade. So say you get in at support, it moves up, but then it comes back down and it touches support again. You might want to take, say a quarter of that position off of that trade, because the probabilities of it failing just like went up a lot. And then last but not least, if you want to, send some Bitcoin or USDT or XRP over, I do have these QR codes, so you could just scan the screen and, send some Bitcoin or USDT or XRP, and that would be appreciated. Obviously, if this helped you and you end up learning a lot and doing real good, these are some of the addresses. And with that, I just want to say thank you so much for watching, and I will see you in the next videos.